Welcome to the Creative Minds Smart Money Podcast, where we turn financial confusion into creative confidence. I'm Samantha Eck, bookkeeper and fractional CFO for creative entrepreneurs. Each week, I'm sharing my financial expertise and actionable strategies to help you build a thriving creative business. Plus, you'll hear from industry experts who bring fresh perspectives on growing your business beyond the numbers. Because building a successful creative business starts with strong financial foundations. Your next chapter starts now. Woo woo! Welcome back to another episode of Creative Minds Smart Money. And today we're talking about business savings. Oh, such a boring topic. No, I'm just kidding. Business savings is so fun. I'm sorry, I'm energized by the fact that my dogs are in here with me. So I'm like super pumped up. Anyways, business savings is not a boring topic. And there's a lot that we can actually touch on in this episode. And there's a lot of different ways that you can set up your business savings, but I want to talk about kind of the cash architecture that you can set up now that's going to help you forever and that's going to help you with a lot. So when I think of business savings, I think of more than one account, and I usually think of 1 to 3. And usually it's more than one. So usually it's at least 2, if not 3 accounts. And obviously there's a reason for that, but let's kind of dive in and chat about that. When I first have a 15-minute conversation with someone and we're talking about their business and we're talking about their finances, usually the tell that I can tell if someone's going to lose sleep over cash this year is when they're talking about they just don't know if they have enough to cover expenses, or they just don't know if they have, enough to take a vacation or whatever it is. It's a lot, and it's what happens when you are only looking at, one savings account or across one thing. So a lot of times they'll say, I have a savings account with no follow-up is usually an answer that means that there's trouble. So usually they're saying, oh, I have a savings account for taxes and everything like that, but they're not fully looking at the bigger picture, right? The money in that one account is doing 3 jobs at once. The owner is keeping track of which dollar belongs to which job mentally, whether that's taxes, whether it's an emergency fund, whatever it is. And the pattern does work really great for this account until Q2 tax, slow season, or an opportunity all show up at the same time. And usually when we're in that mid-year progress hump, we're like over the edge and we're like, yeah, we're going. That's when it really tends to show up. There's 3 jobs that I like to say cash has to do in a healthy business. And this is 3 jobs. And a lot of people will say, oh, Samantha, isn't this kind of similar to like a profit first? Not really, because we're not really looking at all these things. So there's 3 things that your cash is actually being asked to do. First of all, and I've said this many, many times, the first one is a tax reserve. This is money that you owe to the tax authority. It's untouchable, but for any other purpose other than taxes. It's essential. You need to have in your business. That is the first savings account, and one of the most vital that you should have is your tax savings, okay? The second one that I talk about most often is an emergency fund. This is 3 to 6 months of operating expenses that's only spent when something breaks, or maybe you're taking time off or whatever it is. This is your emergency fund. If you have a family member that passes away and you need to take 6 days off in an emergency, you have money to cover yourself, okay? That's what your emergency fund is there for. That's the purpose of your emergency fund. I know it seems really dull to just have money that is saved up and just like sitting there, but it's also not the greatest opportunity for you, right? If you're not having that money like put aside, and all of a sudden, again, like we talked about in a few weeks ago in that episode where, you do have a family member die, you have to take time off. Maybe it's medical leave, whatever it is. You're going to regret it when you're like, oh my gosh, now I'm panicking. Okay. Then you also have the third one, which is the opportunity fund. And usually, I don't mind if people keep this in their main bank account. I have a client that does that right now, and we use YNAB to track all of this, but it's the opportunity fund. It's the money for hires, equipment, courses, expansion. So it's almost like a savings bucket. Essentially, it's where we put money that we're saving up for these bigger opportunities, things that will cost you more than just, $30. When all three of these end up sharing an account, they feel heavier because you're making a call against all three jobs at once. And that might sound silly to you, but it's 110% one of the things that I notice the most is when people have a tax account and they also have emergency fund, they also have this in there, and they see it drop all of a sudden, or they see a bunch of different things going on and they're like, oh my gosh, like it seems silly to have these accounts that are labeled in this manner, but it's also very helpful to your brain to be like, oh, okay, like my taxes went out. That's great. That means that they're paid. And then if you're looking at your opportunity fund and being like, oh, okay, so I sell $5,000 to be able to afford a website redesign or whatever it is, that's going to help you, right? And knowing that you have that emergency fund sitting there, maybe that $5,000, $6,000 sitting in your bank account, being like, okay, I've got money stocked up in case I have an emergency. Now, of course, there's always the time when people are like, oh, I can just be better with my money. I don't need three accounts. But the problem isn't that you're bad with money, right? Like the problem isn't that you are inherently like trying to do this. The structure of where the money sits is it creates that clarity that, and not necessarily the willpower around it, right? Because you can be an amazing person. You can be like, oh no, I have really good willpower when it comes to spending money. But when you see these things reflected in the proper account, it just changes things. Physical separation is going to make the math like automatic instead of mental. Instead of trying to be like, do I have enough for this? You can literally look at this one account and be like, oh yeah, I want a website redesign. I've got $5,000 in my opportunity fund. Done. The setup obviously is going to tie back to your forecast because the right tax reserve percentage depends on your revenue picture and your entity structure. And obviously that's going to make sure that you have everything kind of like tied together. Obviously, this is a very CFO level conversation, and it's about how cash should flow with having like a good forecast. Most of the time with your cash flow forecast, we're purely looking at your operational account. When you move that money into your opportunity fund and things like that, and you have, the opportunity to do that with your opportunity fund, it's so much easier to be able to just spend that money without having to worry about it affecting your operating cash flow because your operating account is just clean and it's very nice to look at. Now, obviously, when you have all of this set up, it does help you a lot emotionally as well as mentally. A lot of clients will tell me that they notice, a lot of a weight lifted because of course when your tax bill arrives and the money's already sitting in that reserve account, it's easy to just pay it. It's not something that they feel like, oh my gosh, am I going to ever have enough to pay taxes? A slow month isn't going to trigger you to get a loan or a credit card because your emergency fund is going to be able to absorb it. Like you're going to be able to look back and be like, okay, I have enough money stocked up that I can just use my emergency fund if I need to. And then an opportunity is going to come up that you might have had to pass on because you weren't able to save up to the money, like you weren't able to save up enough money for it. And now your opportunity, instead of your answer is yes, no, or it's let me look at my cash flow forecast and see where I'm at. So you have that ability to have those answers, right? You could still say no, but now you have the ability to say yes as well. Of course, you're going to stop calculating risk against just the whole pile of your cash and being like, oh, okay, but now you're going to be able to look at things and be like, oh, I'm calculating against what's actually in there. So if you're like, oh, I might be thinking of doing a website redesign, but you have an opportunity to come up that's maybe like an educational course, you get to make that decision now and say, is this educational course worth more than my website redesign? So it's something you definitely get to think about. Now, there is a rule of thumb where usually we say save 25% for taxes. And of course, 25% is an average that's wrong for almost every individual. And usually I will always tell my clients to put in more. Usually it's more like 30% because I want you to be able to hopefully get some sort of refund back. But it does generally depend on your entity type, your owner's pay structure, your deductions, your state, and your revenue, because they're all tied to that tax number, right? The right percentage is also forward-looking because revenue growth changes the bracket math, and obviously that's a conversation you want to have with your CPA and not me. But when we're looking at your business and we're looking at everything and we're saying, okay, we're calculating all those expenses and everything like that, we're pulling your taxes not based on your revenue number, but based on your net income because that's the number that's going to be taxed, right? And of course, the right tax reserve is looking at that forecast, looking at that profit and loss, and being able to look at and answer everything in that. Now, I know it might seem like a lot when you have all these different savings accounts, but it's really, really simple. So the main one that you want to be concerned with is obviously the tax account, and the emergency fund can be built slowly over time. And I always tell my clients this, maybe just put $10 in it over the next month. Maybe, when you have a little bit of extra, put that into your emergency fund and slowly build it. Slowly build that fund up to be the 3 to 6 months of expenses you want to be. You don't have to feel pressured to build it all up in days. It's not something that needs to happen instantly, but it is something that needs to be there. And then your opportunity fund is probably the last thing that you need to build up. Focus on making sure that you have enough for taxes. Focus on making sure that you have an emergency fund built up, and then work on your opportunity fund. As much as it sucks to have to set aside money, at least once you have your emergency fund funded, once you have money set aside for taxes, then you have extra money that you can play around with for your opportunity fund and to be able to have that, okay? So three accounts sounds like a lot, but if it's something you want to talk about, or maybe something you're like, hey, Samantha, is this right for me? How much I'm setting aside for taxes? Shoot me a message and let's have that conversation. Obviously, the deeper tax stuff is definitely meant for your tax accountant, whoever that is. But I'm always here to help and try and guide you in the right direction. As always, you guys, if you like this episode, please like it, share it, subscribe it with your friends, family, so that we can get more people listening to this and we can have more conversations like this. As always, I wish you the best week ever, and we're going to see you next week. Farewell, fellow travelers.